Good evening. Welcome to Prime Time with Faisal Rashid. Here we share experiences that inspire you to think bigger, work smarter, and grow stronger. Let's get started. Audience, I hope you enjoyed my first program, which was based on startups. And we discussed, just to give you a little bit of recap, last week, we discussed about startups, how it works, and what help is available to you all. And we had Heather Waters from Greater Manchester Growth Hub, and she did explain exactly what sort of information you can get and support you can get for startup businesses, any ideas you may have. There are startup loans available. So we discussed all that in last program. I hope you enjoyed it and found useful. Audience, today's topic is investments. So the reason I have chosen today's topic, investments, is that there are lots of questions my clients and journal friends and family ask all the time about where is best return on investment, how do we invest, where do we invest, what are the risks. So there are so many questions out there. Audience, please note that any advice on this program is not an advice. So we are only talking about general topics and giving you factual information. Even my guests will be explaining to you how these products work. However, we emphasize that if you need any advice, you must seek from an expert who is qualified to give you that advice, and that would be also as per your personal circumstances. So I hope that's clear. Today, I have a guest which we will introduce you in a minute. And this guy is called Saftar Sarwar, and he's from Binary Capital, the company based in London, central London, and they have wealth of experience. This is also about listening to these individuals, how their journey has been, and also look at how they've started up their own businesses and where they are today. It will be very inspiring hour. I'm sure there are lots of things to discuss with Saftar, and I'm pleased to introduce you to my guest for today's program, Mr. Saftar.
Thank you, Faisal.
Hello, Saftar. Welcome to my show.
Thank you, Faisal. A pleasure to be here with you on your
Excellent.
show.
Saftar, thank you very much for coming, and on a very short notice as well, because I just thought yesterday, so we should do a program on investments. And, you have a wealth of experience, and I thought I will take you on to my show, and let's give audience a wealth of information today in this hour. Mm-hmm. First of all, I would like you to introduce yourself, a little bit of background about you and your company.
Yeah, if I may, Faisal, for yourself and for your audience out there, uh, I've been running an investment business in London for the last 7 years. Binary Capital, as you've said, fully FCA authorized and regulated by the FCA in London. And overall, Faisal, I've got roughly, for your audience to know, 30 years investment experience.
Wow.
From Scotland, which is where I was born and raised and educated, and now in London running or helping run my own business for the last 7 years. So I've worked in banks, small investment companies to big banks and institutions. And I've seen over that 30-year journey, many investment markets, trends, bubbles, and areas of good investments, bad investments, and so on as well. So very experienced in terms of different investment strategies and so on as well. So quite a varied journey to get here now in terms of running a business, working hard with clients. When I say clients, we work with a lot of independent financial advisors all across the UK, Aberdeen, Edinburgh, Manchester, Warrington, everywhere, and London, to give them top quality investment solutions, which they can then subsequently engage with their clients. You know, Mr. Smith, Mrs. Jones in the high street that's looking for their pension or ISA or whatever. And as I said, because of my experience and the team that we've built up over that 7 year journey, we like to think we do some really good work in this space. So a pleasure to be here this evening with you, Faisal. You're a very good friend of mine. I really respect the work you've done in politically as well as now in business for the many years now as well, and being an icon in Manchester, Warrington, and so
Oh
on
my
as well.
God! Thank you so
Mm.
much, Saftar, for excellent. Thank you so much. I'm blushed. Right. Okay. So I think let's start from the types of investments. If you may start with some tax-free investments, or there are some taxable investments. So how would you differentiate the benefits of these investments? So if I may ask you to explain, maybe through cash ISAs, stocks and share ISAs, then there is a deposit investments. So what are the differences, and what types of investments are available for the public?
The Republic has many investments available. You can get tax structures, like you said, an ISA, individual savings account, or pension plans for people if they're in employment where they can contribute to a company pension scheme, which the company also contributes to. They can also, if they've got various pensions that they've built up over time, create their own self-invested pension scheme
Okay.
called a SIP as well. So there's many tax advantages or benefits of holding investments in such a structure, or even cash. You mentioned cash ISAs. So if you want to have your money on deposit, for example, £10,000, £20,000. Again, you can place that in a structure where you can actually get a tax benefit as opposed to giving some of the income or capital growth to the tax person, taxman, being taxed for income as well as capital gains tax as well. So there's benefits. So one should definitely look at this to maximize their return opportunities as well as tax benefits overall, for individually as well as for even corporates as well. Corporates can hold different
Yeah.
pensions or different assets in a pension scheme as well. SAS is one example of
Yeah.
that. A little bit complicated, but we can go into
I think
that
I think
if
what
one needs to.
we're drifting away from different, obviously from cash to pension. So what I would like to do is, for audiences. So if we talk about one by one, each individual types of investments are available, or products are available. So for example, let's say start with, like, there is a saving accounts. So there are lots of people actually put their cash into saving accounts, but their interest rates are too low, and then they are also taxable interest. So then you've got cash ISAs, and then you've got stocks and shares ISAs. So what is the
Yeah,
difference between stocks and share ISA and cash ISA? I understand the difference between ISAs and the normal saving account is that ISAs are tax free. Any profit you generate from those cash ISAs or stocks and shares ISAs is tax free. But as compared to saving accounts, any income generated or profit generated from those saving accounts are taxable. Is that correct?
that's correct.
Yeah,
Again, everybody should be seeking their own investment
of course.
advice or tax advice because every circumstance, individual circumstance, is different. So always seek that. But in general terms, as you said, cash rates are low. UK bank base rates are around 4%. Okay. So taking the bank's margin into account, if you have a savings product in the high street through some of the banks, you may only get 3% on your cash per annum,
Okay.
which is not much for, say, £100,000. You're only getting £3,000 a
3,000 a
month.
year, yeah, that's right. And plus you
Yeah,
pay
a year,
tax on it
sorry.
as well.
Indeed. So you'll be
Yeah,
taxed based on your tax rate, income
yeah.
tax,
It's
higher rate.
20% or 40%.
Indeed. So you're taxed on that. So again, that's a further lower return on your cash. And as we well know, Faisal, inflation is high in the UK. So technically the money is not keeping in touch with inflation rates. So
Yeah.
the
True.
purchasing power of money is going down if you hold it in cash in those terms as well. So that's
Okay.
why for some people, you may want to hold such investments or cash in a stocks and shares ISA, which the government allows you to have 20%, so £20,000 per annum, and each tax year in a ISA structure that you can either open up in the high street bank or with your investment company or investment accounts. Very easy to do online or in person. It's like opening a bank account, Faisal. It's not too hard. One needs to
Yeah.
do so. And the beauty of having a stocks and shares ISA or investment account anyway is you're then investing not in cash deposits for yourself and getting low returns, as we just said, maybe
Yeah.
at best 2%, 2.5%, 3% per annum. You're getting returns based on the profitability and growth of often some of the best companies in the world, whereas UK companies like British Telecom,
Yeah.
Vodafone, or US, Chinese, emerging markets company in India, and so on. And those
And
profits,
that's
therefore,
stocks and shares ISA you're talking about, yeah?
that's
That's
correct.
a
That's
stock.
stocks and
So,
shares
so,
ISA.
so the difference between cash ISA and stocks and shares ISA is that the cash ISA, you have annual allowance of £20,000 every year, which is tax free. So you can accumulate that allowance every year. And for example, in the next 5 years, you can have £100,000 sitting in a cash ISA, and any interest you get out of that is tax free. Correct?
That's correct.
Yeah.
That's correct.
And then there is a difference between cash ISA and stocks and shares ISA is that in stocks and shares ISA, there is no guarantee interest as compared to cash ISA. If you if the provider is giving you 4%, for example, or 4.5%, but that is guaranteed for that term, whatever the terms and conditions would be. But in stocks and shares ISA, so how would you? So, for example, if I want to invest £20,000 in stocks and shares ISA, what are the risks involved, and can I actually choose the medium risk, high risk, or low risk products within that fund manager through stocks and shares ISA?
Yes, very, very good point, Faisal. And something to bear in mind, there's a big, big distinction. With a cash ISA, your money is in deposit with the bank or banks, high street banks. As we all know, since over the last 100 years, they've been very, very safe and secure, typically backed by the UK government. We saw evidence of that in the credit crisis 15 or so years ago. In a stocks and shares ISA, where you're investing in different funds or different shares. When I say a fund, that's like a UK investment fund and so on. You are taking on investment risk, as they say. You are buying into different companies. So the return, unlike a cash ISA, is not guaranteed. It is linked to the profitability of that company. One
Okay.
year, that profit might be high, they make a lot of money, so they can pay dividends, which is like an income stream to
Yeah.
the investors, and they might make extra profits. So therefore, based on those extra profits, the share price might go up. Therefore,
Okay.
you're making a return on that investment. And therefore, typically, if that happens, the share price goes up a lot often. To give you one example, even today, Monday, um, the 27th of October, the US stock market was up a lot earlier on when I looked, 1 to 2% in one day. So imagine you can get that return of 1% in a day. That might
Wow.
get you only 2.5% in a year in a cash
Okay.
ISA. But as in anything, it's quite volatile. Profits go down or their losses, shares can go down. Companies
Yeah.
go bust as well. And so therefore you might lose all of your money. It's quite rare, but
Yeah.
you can technically lose all. You are taking on, as they say, investment risk. So only do so if you are prepared to take on such risk and you want
Yeah.
to hold that investment for the long term. You're prepared to hold it for often 5 years or 10 years, and you have cash set aside anyway for a rainy day or for
Yeah.
a reserve, and you
Yeah.
have extra money that you want to invest for the long term, whether it's for, future retirement income or returns, or for your children's school fees, or grandchildren, or nice holidays in the future, or whatever. So that's what you should need to focus around, or understand as well, Faisal. Hope
So
that's
is
clear.
it right saying that higher the risk is, the higher the reward could be? Is
That's
that correct?
correct. Some people have
Yeah.
low risk or low return cash ISAs with investing bonds and lower risk investments, or some people do higher risk or higher
Okay.
return investments. For
So
example, in emerging markets,
yeah.
India, China, or whatever, as examples.
Okay, that's fine. So obviously we discussed about the cash savings, then we discussed about the ISAs, which are tax-free products available. But at the same time, if somebody's got more money, for example, they want to invest, so they have maximized their cash ISAs, or they maximize their stocks and shares ISAs, and they've got extra funds they want to actually invest into stocks and shares. So beyond that allowance, it will be all taxable, correct?
That's correct.
Yeah,
Beyond that tax ISA allowance of 20,000 per year, and I
yeah.
would encourage everybody to look at that to try and maximize that, or certainly use that in any fiscal tax year. £20,000 is a good amount of sum,
Yeah.
certainly before the budget next month, which may change.
Yeah.
But separate to that, Faisal, you can obviously invest as you wish to do so.
Yeah,
50,000, 100,000 extra money in your general investment account is called, and that is subject to um, income tax based on the dividends you might get or the
yeah.
yield on the investment, and it's also subject to capital gains tax above certain thresholds of tax-free allowances, which again are subject to changes by the government as well. Again, you will be taxed at your tax rate subject to that as well. So one needs to look into that and manage that as well if it's possible to do so.
Excellent. Okay, so I think it's quite interesting discussion going on right now. I think we will take a very short break. But audience, there is a mobile number for text messages. If you've got any questions, you may ask and send me a text message, and we will ask that question to Saftar as well. So let's take a short break. Welcome back. We were talking about investment and types of investments available. Saftar, what I would like to ask you now is what is the difference between Sharia compliant investments and the conventional investments?
Okay, so it's quite kind of simple in some respects, Faisal. Sharia compliant investments are based around the Islamic faith. As we know, as Muslims, we follow certain guidance and rules of our faith. People pray, people pray 5 times
Mute
a
करो
day.
मैनू.
They eat halal meat. You try and go to pilgrimages and so on regularly or once in their lifetime. And at the same time, there's also different decrees around how you should be doing investments,
Okay.
based around profit sharing, based around ethical investing, and investing in companies or sectors or society that doesn't do harm. For example, not investing in or not participating in alcohol companies or
Okay.
alcohol business and so on, or gambling. And so Sharia compliant is based around those kind of principles where a fund or a strategy is therefore then structured around those principles. So you then invest in companies that are excluded based around alcohol, gambling, tobacco, maybe some other companies as well, based around different Islamic scholars' opinions and so on. And those then funds then, Faisal, are sold to Muslim and even non-Muslim investors if one wants to invest that way anyway, because some people want to do that as part of a kind of ethical framework. So that's the difference between that and investing in a normal way where you can invest in any company, you know, British American
So,
Tobacco, and Smith Scottish and Newcastle or whatever.
so you have some fund managers who actually, if somebody comes to you and just say, okay, I want to invest, let's say, £100,000 into stocks and shares, ISA, or generally in stocks and shares, and I only want to invest in the companies which are Sharia compliant. So how do you work that one out then? Is that you got specific funds available for those kind of people, or?
Yes, there are some specific funds available on the market run by some of the best investment companies in the world and
Right.
banks that we can do our due diligence on, double check, are these funds actually Sharia compliant? If so, how and why? What kind of framework do they use to become Sharia compliant? And then we will look at that and then invest in them, again, subject to what I said earlier, Faisal, based around different risk profiles. And
Yeah.
then obviously clients have that option to invest if they so wish to do so. Again, it's just about giving people a choice in a democratic, free society, giving people a choice according to their wishes, whether it's faith wishes or their criteria. Some people have an ethical criteria anyway,
Yeah.
so they have the right to invest according to that framework.
Okay, that's fine. Interesting. So, what is the rate or return on investment on stocks? Um, let's say, give me some kind of average figure that you have achieved for your clients, let's say, over the last 12 months, low risk, medium risk, and high risk investments. What is the
Yeah,
average
and again,
return?
Our binary capital, as I said, what we're obviously clearly do this every single day. We live and breathe this, and I've got 30 years of doing this, Faisal.
Yeah.
Way back before the internet and before some of these stock markets got really strong growth and so on. Typically, a client, a medium risk, let's look at medium risk, okay? A medium risk client, so we call it a balanced client. Say they're in the mid 40s, they've got 20 years to retire and so on. They want to take on a little bit of risk, but they're a bit cautious as well still, perhaps.
Yeah.
They should expect to get on a normal year 10%, 8 to 10% return per annum.
That's pretty good. That 8 to 10
Yeah,
percent on a medium risk,
yeah,
and perhaps on a high
yeah.
risk it would be over 12, 13%.
High risk
That's
should be closer to 14% or so. And this is what we've achieved this year.
okay.
And for the last 3 years, Federal Binary's balanced strategy, passive balance strategy, has returned circa 12% after fees to the clients as well. So that's
Okay.
typically and contrast that to cash. We discussed cash earlier.
Yeah.
Cash will give you maybe 3% or 2.5%
Yeah.
at best per annum, while a balanced investment portfolio will give you 10% perhaps. So a lot more. So
And that is
therefore your
also net.
cash
That is also net
net
10%.
indeed. So
Yeah.
that is net. So therefore, assuming that example of £100,000 again, rather than getting £3,000 or £2,500 return, why would you not want to get 8,000 or £10,000? Why would you want to miss out on that extra £7,000 to £8,000? Especially if you can take a long-term view, you want to be patient, you're willing to ride out the volatility or the risk of investing in the stock markets and investment markets. That makes perfect sense to do so, we believe, for clients that in their 30s, 20s,
This is
30s, 40s, even 50s and 60s.
I think this is a very good return on investment if you compare to property market. So, for example, the people who invest in properties, especially in down south, they are returning on what 4%, 5%, maximum 6% around London, and they are very happy with that kind of return. When you look at the return in a medium stocks and shares, stocks and shares is around 10%, which is pretty good. But I think on property return on investment in Northwest is pretty good, which is around 8% to 12%. It ranges quite depending on how you're buying. Um, but but one difference I think is about if you buy a property, even if your return on investment, what it is 7%, 8%, but there is also a capital appreciation of the property as well. So there is nothing in stocks and shares. Is that correct, or do
No,
they
no,
appreciate as well?
Faisal, again, similar, very similar, like property. Stocks and shares are just another asset. Property is an asset. You live in it, you rent it out,
Yeah.
you have it for commercial use or whatever. Stocks and shares ISA is where you're investing the best companies in the world, potentially. Whereas in America, in China, in Asia,
Yeah. Mm-hmm.
or Europe, and those companies will give you an income like property does, a yield, not rental income, but dividend income, as well
Yeah.
as growth. So that 10% I refer to is capital plus income for that investment in a medium risk client. So to give you another example, this year, because of the AI and technology boom, excuse me, and hype, many stock markets are up 15%, 20%, and
All
so
right.
on. So one can get a lot more returns. I mean, NASDAQ, which is a technology index based in the US, since early April after Trump around some tariff reprieve, is up 50%, 50 in
Wow.
5 months or so, 5 or 6 months, Faisal. So you can get significant returns if you know what you're doing, if you research and are experienced and willing to be patient and ride out the volatility, ride out the downward trends. Because typically, many companies, especially the best companies in the world, make profits. They grow, they acquire other businesses, they have good management. You know, Economic growth is always growing, maybe slow but growing. The US is a powerhouse, so is China. There's amazing companies in healthcare, technology, biotechnology. People are living longer. They need better medicine. They need cheaper medicine. So how does that come? That comes from the pharmaceutical companies. That comes from the biotechnological companies, and so on. People want better surgery. So now you can even get robotic surgery, and some companies deliver that. So you can get share prices growth based on healthcare like that. Even taxis, Faisal. Uber, as you know, is a stock that's listed in the
Yeah,
US
it
market,
is. Yeah.
doing great. And you've got other companies that are coming into the UK that are self-driving taxis owned by Google or Alphabet. So there's so much innovation happening now that one should be participating if one is looking to take on stocks and shares risk if they want to do so for their investments or cash or their pots of money separate to property.
Okay. Okay. So, I mean, you mentioned about lots of stocks around the world, and you have access to all the stocks in China, US, Europe, everywhere. You can actually invest in those stocks.
That's correct. Subject to different criteria, we, because of our expertise, because of our license, because of our links to the best investment banks and investment houses, not only in London, Faisal, in Edinburgh, Frankfurt, Paris, New York, Hong Kong, Shanghai, we get access to the best ideas in the world, which
Okay.
we can then subsequently, after doing prolonged due diligence and research, like you would do with any investment, whether it's buying a car or a property or whatever, and then
Yeah.
we invest that, diversify that and invest that on behalf of our clients. And so they can then benefit from those investments as part of their
And that's why
diversified
you need, that's
investment
why,
portfolio.
yeah, that's why you need those experts who actually just deal with those stocks, and they know in and out about all those stock markets. And this is why it's important that you seek a expert advice on investments. Um,
Yeah, very important for
yeah.
everybody watching or listening. Please do your own research, read the newspapers or business shows. As well as that, there's always IFAs in the high street, in your local towns and cities. Speak to them about ideas. investment ideas or whatever,
Yeah.
if they want to speak to me, I'm always on LinkedIn, so they can happily engage with me at a high level as well, Faisal. So, but definitely seek investment advice. This is not for novice people. People can lose a lot of money. Sadly, because of naivety, there can be a lot of scams out there as well. So one
Yeah.
needs to be very careful in that context
And
overall.
also, Saftar, I think you should not put all your eggs in one basket as well. So whenever it's a investment strategy comes through, I always hear about, there are three main investment strategies could be where you can invest. So there is, of course, we talked about the cash investments, and there are, saving accounts, or you can buy bonds, cash ISAs, stocks and shares, normal accounts. You can do that. But then there is also a property portfolio. So you can always have a property portfolio. You've got cash investments, then you've got pensions. So there are three strategies which normally people do talk about. I'm going to move now towards pension side of it, and let's touch base on pensions. What are the benefits of having a pension and paying through company? What are the tax benefits are there? And there are still lots of people actually making lots of profit in their companies, but there are ways where you can actually reduce that tax liability by having a pension scheme, and any investment to pension from the company comes as an expense. Hence, it reduces your tax liability and reduces your profit. So, would you mind touch base on pensions, Safta?
Yeah, indeed, Faisal, you're absolutely correct. Pension schemes or pensions, whether it's your individual pension through a SIP or through a corporate, you should definitely very, very carefully look at them to try and take advantage of that. It's essentially free money, for example, because by law, a company needs to give you a pension plan, okay,
Yeah.
typically. And the company will contribute to that. So therefore, if they're going to contribute money to you in your pension plan, you should also try and contribute to it or try and partake in that as well, because the money you then contribute is taken off your gross salary. Therefore, you're not taxing that money typically. So why would you not want to reduce taxes, increase your pension pot, and then use that pension scheme with a contribution from your employer as well and grow that over time, which means when you come to retirement, wherever age that is, you can then draw down that money and use that as part of your pension scheme, as well as your state pension or any other
Yeah.
investment income you've got as property and whatever as well. As you said, Fez, it's just another way to manage your wealth or cash or your investments as part of a tax efficient way. And the thing with a pension scheme is you can invest that similar to what you're investing in an ISA or a stocks and shares portfolio. And you can invest in the best companies in the world at low cost often in the US, China, Europe, the UK, and so on. So you can take advantage of that uh, by contribution from your employer, your own contribution as an employee, as well as a tax benefit. So you should definitely be looking at that if you haven't done already and reviewing it every year to make sure it's fit for purpose. The asset allocation is correct. Your eggs are not in the same basket. You're well diversified. You're looking at the best companies or funds not to invest in now, but in the future, 2026, 2027, and so on. Things are changing rapidly. Hence the reason, Faisal, again, stressing the point, seek advice, seek professional
Yeah.
advice, look
I
at
think there is
experts that you
something.
can get knowledge from.
There is also a very valid point here is that when you create that wealth through pension, and you've got a pension pot, and at the age of 55, when you turn 55, you can actually draw down 25% of your pension pot as a tax-free lump sum. Correct, Safta?
That's correct as well.
Yeah.
Again, the government may change that rule because just be careful in terms of budgets coming up next month. But that's correct. When you turn 55, say you have a £100,000 pension pot, technically you can draw that down Okay,
Okay.
25% of that. So £25,000 in that example, tax free, because it's your pension scheme to invest or do as you so wish to do so. Maybe you want to,
Yeah.
have an extension in your house or buy a nice car or go on a nice
Yeah.
holiday or holidays.
Yeah.
So
Exactly.
wherever you wish to do so. Again, there's
Or you want to
flexibility
pay
there.
your mortgage off. I mean, you can lump sum, you can pay
Indeed,
towards your mortgage
indeed.
off.
Pay your mortgage off
Yeah.
and have a less mortgage or have a house with no mortgage on it. Whenever you wish to do so.
Exactly.
There's a lot of
And
freedom there.
I think it's important to tell the audience here also, Saftar, is that there are different types of pension schemes as well. So, Saftar mentioned that SAS and there is SIP, I think self investment pension plan, something that's what it's called. What you can do if you turn your pension is a SIP type of pension, then SIP can actually buy commercial properties for that funds. So you can still invest into a property by having a pension pod, and that pension pot is building up through your as an expense funds released from your company going into your pension pot. So you're saving tax there, plus you can actually have a property for that funds, and you can return on investment through the rental income and commercial properties, as you know, the long leases. So if you got a decent tenant signed up for 10 years, 15 years, whatever, so it's a very good income coming in, and that is all build up through your tax-free allowances through the company. Is that a fair point, Saftar? But I'm not
And it's
very
a fair
expert.
point, Faisal.
But yeah.
Yeah, and again, a fair point. Again, you can use different assets to invest in your corporate pension scheme or your
Yeah.
individual pension scheme, whether it's a property, commercial property, or whatever, or even stocks and shares as well. So again, with expert advice and guidance, you should be able to navigate this kind of tax and pensions minefield, because there's a bit of a minefield overall. But you can do many, it's very flexible. You can do a lot with that. It's all about seeking the right advice, having the right strategy, thinking long term, not having
Yeah.
your eggs in one basket, being diversified, as they say, and really investing for the long term, for the next decade, double decade, or on 20 years and so
Yeah.
on.
Excellent. So I think we did talk about a lot about cash investments through tax-free and ISAs and stuff like that. Would you mind touching gilts or bonds, or what other types of investment products are available? And if you can just briefly explain very quickly what gilts are, I mean government gilts, or what is it, and what bonds are. There are government backed as well, or some private banks issue them as well? So how does that work, if you don't mind?
Yeah, indeed. Again, without going into too much detail or jargon, Faisal, a
Yeah.
bond is essentially where you are lending money to a company or the government. Take the example of the UK government.
Yeah.
You are lending them money. They are then going to pay you an interest rate based on that lending amount that you've given them. Okay, it's called a yield. The government, UK government bonds are called gilts. So you lend to the UK government. They will then give you a yield every year, payable every 6 months typically, and then
At the
after
fixed
maturity of
amount,
that
fixed
bond,
fixed rate. Yeah.
fixed amount.
Okay.
Sometimes it varies, but say it's fixed. And then
Okay.
after the bond matures, say in 5 years, they will then pay back your sum back, as assuming you've lent them that money, is they
Okay.
pay back the principal. And because of the UK government, and it's a government, the bonds are quite highly rated, so the
Okay.
interest rate might be low. But then same happens to companies. For example, Vodafone,
Yeah.
Tesla, Unilever also borrow money from people or from the banks,
Oh, okay.
and so
And they issue
you can
their own
buy.
bonds, or how do they
They
do
issue
it?
their own bonds as well.
Okay.
They issue their
Okay.
own bonds that you can also invest into as well. That typically will give a higher rate of return or interest because those are not governments, they're
Okay.
companies. As you know, as I said earlier, companies' profits go up and go down, and so one can be needs to be
So
careful there as well.
how secure these bonds are from the private companies? I'm sure the government ones are pretty much 100% secure. So you
Yeah.
will get your money back. But in
Bonds are
terms of
typically quite secure. For private companies, they're typically quite secure. It depends on the rating. All bonds are rated, but typically from the big private companies, something happens, the bondholders paid out before equities. The bondholders typically linked to the assets of that company, the
okay,
profit assets, the real estate assets of that company, and so on as well. So they're quite secure. Otherwise, they would never be allowed to issue those bonds again, or those bonds would not be worth any money, and nobody would buy those bonds in the
okay.
stock market or in the bond
Okay,
market at
so
all.
they are
It's a
pretty
very big
secure as well.
market.
And very
All
briefly about
governments.
the guilds. Very briefly about the guilds. We've got only 5 minutes to go, so I just wanted to
Sure.
wrap up.
Adele, as I said, issued by the UK government every month, in fact, every
Okay.
week, by the Debt Management Office in London. So you're lending money to the UK government. They need that money. Why do they need that money? Because taxes do not cover all of the spending, the budget that they need every year. Healthcare, police, law and order. So you're giving the money to the UK government. The UK government will pay you an interest rate, and then over time, subject to the different bonds, they will pay back your money back into your pocket as well. Okay,
Brilliant.
and there's different ways you can do government gilts:
Okay.
short-term ones, 1 year, 2 years; long-term government gilts, 10 years, 20 years as well, and you get different rates of returns depending on that as well. And they're
Excellent.
seen as very safe. The US
Brilliant.
government does something similar as well. They call
Yeah.
US bonds.
Excellent. Thank you very much, Saftar. I think it was very useful and really pleased to have you on my show today. We're just running out of time now. Audience, that was Saftar Sarwar from Binary Capital. And we would like to thank Saftar for coming today to my show. Thank you, Saftar. Audience, just before I close today's program, just to let you know, there is a lot of topics out there in terms of the property. There is also about mortgages, opening bank accounts, opening companies, and there will be lots of topics will be coming in my next programs, and we will try our best. But the most important thing is that I need your feedback. I need to know what do you want to hear from us, what topics do you want us to cover, and that would be really, really helpful and makes my job a bit easier. So thank you very much for listening today. Look after yourself and people around you. Till next week, goodbye.